Put your phone on silent. Kick everyone out of the room. Because I'm about to show you the number that proves the game is rigged. And more importantly, the number that proves the riggers are losing. 200%. That's silver's year-on-year return. Not a typo, not a glitch. 200%. The metal has tripled in 12 months, while the so-called experts told you to buy bonds yielding 3%. Ladies and gentlemen, the American guy here. Overnight while you were asleep, the CME Group pulled out their emergency playbook, the one they only use when the house is losing. They rewrote the rules mid-game. Bloomberg just reported that the CME is raising silver margins. They're increasing the amount of money traders need to hold a silver futures contract. The margins just went from 9% of notional value to 11%. And in cases of heightened risk, they're going from 9.9% to 12.1%. Now, if you don't trade futures, that might sound technical. It might sound boring. But let me explain what just happened in plain English. The CME just made it 22% more expensive to trade silver. They just told traders, you need to put up more money if you want to play this game. And they did it because silver is moving so violently, so unpredictably, that they're scared the exchange is going to blow up. This is panic. This is the exchange admitting they can't control the price anymore. This is them trying to slow down the rally by making it harder for traders to participate. And here's the thing. It's not going to work. Because the people buying silver right now aren't leveraged traders. They're industrial users. They're sovereign wealth funds. They're people who need the metal. And raising margins doesn't stop someone who needs 10,000 ounces to build solar panels. All the CME just did is confirm that the market is broken. They put a giant flashing sign on silver that says, this is out of control. Let me give you the current numbers. Kitco is showing silver bid at 112.40, up 0.32 today. That's a 0.28% gain. Not a huge move compared to the insanity we've seen lately. But look at the days range, $110.59 to $106.24. That's a $6 swing in a single session. FXStreet is reporting silver surged to near $113.50 per troy ounce. They also confirmed that silver is up more than 200% year on year. And they mentioned that Citi's 3-month forecast is $150. So let me put this all together for you. Silver's up 200% in a year. It's currently trading between 112 and 113. It's swinging $6 a day. The CME just raised margins because they're scared. And Citi is forecasting $150 in 3 months. This is the end game. And the people running the exchange just admitted it. Let me explain what a margin hike is and why it matters. Because this is not just a technical adjustment. This is a weapon. And it's a weapon they're using to try to kill the rally. When you trade futures, you don't pay the full price of the contract up front. You only put up a fraction as collateral. That fraction is called the margin. For silver, the margin was 9% of the notional value. That means if you wanted to control 5,000 ounces of silver worth $565,000 at current prices, you only needed to put up about $50,150. But now the CME just raised that to 11%. So instead of $50,850, you need $62,150. That's an extra $11,300 you have to come up with just to hold the same position. And for heightened risk accounts, it went from 9.9% to 12.1%. That's an even bigger increase. Why does the CME do this? Officially, they say it's to manage risk, to ensure that traders can cover their losses if the price moves against them. But the real reason is to slow down the rally, to make it harder for speculators to pile in, to reduce the leverage in the system. And here's the key insight. The CME only raises margins when they're scared. They only do this when the price is moving so fast that they're worried about defaults, about traders blowing up their accounts and leaving the exchange holding the bag. The last time they did this in a major way was 2011. Silver hit $50. The CME raised margins 5 times in 2 weeks, and the rally collapsed. Silver crashed from $50 to $30 in a matter of days. So the question is, will it work this time? Will raising margins kill the rally like it did in 2011? No, and here's why. In 2011, the silver rally was driven by speculators, retail traders, people using leverage to bet on the price. When the CME raised margins, those traders couldn't meet the new requirements. They were forced to sell, and the selling created a cascade that crashed the price. But 2026 is different. The rally this time is driven by physical demand, industrial users who need silver for production, sovereign wealth funds buying for strategic reserves, Chinese buyers securing supply. These are not leveraged speculators. These are entities that don't care about margin requirements because they're not trading futures. They're buying physical metal. So raising margins might shake out a few hedge funds. It might force some momentum traders to close their positions. But it's not going to stop Tesla from buying silver for their cars. It's not going to stop China from importing every ounce they can find. All the CME just did is admit that they're losing control. They're trying to put out a fire with a squirt gun. and the fire is spreading. Now let's talk about the number that should be on the front page of every financial newspaper in the world. Silver is up more than 200% year on year. FXStreet confirmed it. Bloomberg implied it. And if you do the math yourself, it's undeniable. 1 year ago, silver was trading around $30 to $35. Today, it's at $112 to $113. That's a 220% to 276% gain depending on where you mark the starting point. This is not normal. This is not a standard bull market. This is a moonshot. Let me put this in perspective. The S&P 500 averages 10% per year. Bonds give you 3% to 5%. Real estate appreciates 5% to 8% annually. Those are the normal returns you expect from traditional assets. Silver just did 200% in 1 year. And here's the scary part. It's not slowing down, it's accelerating. The gains in January alone were nearly 50%. We went from around $75 to $113 in 1 month. That's a faster pace than the entire 2025 rally. When an asset moves 200% in a year, one of two things is happening. Either it's a speculative frenzy destined to crash, or the currency measuring it is melting like ice cream in July. Given that gold just hit records, stocks are hitting records, and your grocery bill is hitting records all at the same time, I'm betting on door number 2. The dollar isn't stable. It's dissolving. And silver is just the most honest thermometer in the room. But here's the question nobody's asking. If silver is up 200% in a year, and Citi is forecasting $150 in 3 months, what's the total gain from the starting point? Let's say silver was $30 a year ago. If it goes to $150 by April, that's a 400% gain in 15 months, 400%. That's the kind of move you see in penny stocks, not in globally traded commodities. And yet, here we are. The numbers are on the screen. The data is real. And the institutions are starting to acknowledge it. Now let's look at the intraday price action, because the volatility is telling you everything you need to know about the state of this market. Kitco shows the day's range at $110.59 to $116.24. That's a 565 swing in one session. Think about that. Silver opened around 110, spiked to 116s, and then pulled back to 112s. If you were a day trader, you could have caught a 5% move in a matter of hours. Or you could have gotten stopped out at the top and lost money on a move that ended flat. This is not a market for amateurs. This is not a market where you can use technical analysis and trade patterns. This is chaos, pure, unfiltered chaos. When you see $6 swings in a single day, it means the market has no idea what the fair value is. Buyers are willing to pay $160. Sellers are willing to take $110. That's a 5% disagreement on the value of the same asset in the same 24-hour period. And the range has been widening. A few weeks ago, we were seeing $3 or $4 swings. Now we're seeing $6. Next week, it might be $10. This is what happens in the final phase of a bull market. The moves get bigger, the volatility explodes. The price action becomes untradeable for anyone using traditional methods. And the CME knows this. That's why they raised margins. They're looking at these 6 swings and realizing that if a trader is leveraged 10 to 1, a $6 move against them could wipe out their entire account. And if enough accounts blow up, the exchange is on the hook for the losses. So they're raising margins to reduce leverage, to force traders to have more skin in the game. But it's too late. The volatility is already out of control, and raising margins does not change the fundamental supply-demand imbalance that is causing the volatility in the first place. So here's where we are. Silver is up 200% year on year. It's trading between $112 and $113. It's swinging $6 a day. The CME just raised margins to slow down the rally, and Citi is still forecasting $150 in 3 months. What do you do? First, understand what the margin hike means. It means the exchange is scared. It means they see the same thing we see. The market is broken. The price is out of control, and they're trying to slow it down before it explodes. But margin hikes don't stop physical demand. They only stop leverage speculation. So if you're trading futures, if you're using leverage, you need to be very careful. The CME just made your game more expensive. And if they raise margins again, which they probably will, you could get forced out of your position. But if you're buying physical silver, this changes nothing. In fact, it confirms everything. The exchange just told you that the rally is real, that the volatility is extreme, that they're worried about the stability of the system. That's not a sell signal, that's a buy signal. Second, accept the volatility. Silver just swung $6 today, it might swing $8 tomorrow. If you can't handle watching your position go up and down by 5% in a single day, then don't buy. Because the next 3 months are going to be even wilder, but if you can hold through the chaos, if you can ignore the intraday noise and focus on the 3-month target, then buying physical silver at $112 is still a trade worth taking. Third, recognize that the rules are changing. The The CME just raised margins. They might raise them again. They might implement position limits. They might restrict trading hours. When an exchange gets desperate, they do desperate things. And we're entering the desperation phase. So if you're holding futures contracts, have an exit plan. Know your stop loss. Know when you're going to take profits. Because if the exchange changes the rules again, you don't want to be caught holding a position you can't maintain. But if you're holding physical metal, you don't have to worry about rule changes. You don't have to worry about margin calls. You don't have to worry about the exchange declaring force majeure and settling your contract in cash. You have the metal, and nobody can change that. Fourth, watch for more margin hikes. This is just the first one. In 2011, they raised margins 5 times. If silver keeps climbing, if it breaks $120 or $130, they'll raise margins again. And each time they do, it will shake out more leveraged traders and create more volatility. But each margin hike also confirms that the rally is real, that the exchange is losing control, that the end game is approaching. And fifth, remember the timeline. Citi says $150 in 3 months. That's April. We've been saying April is when the COMEX vaults hit 0. We've been saying April is when force majeure gets declared. The CME just gave you more evidence that we're right. They're raising margins now because they know what's coming in April. They're trying to reduce their exposure before the system breaks. This is the American guy. It's Tuesday, January 28th, 2026. Silver's up 200% in 12 months, currently trading at $112 with $6 daily whipsaws. The CME just hiked margins 22% because prices are smashing records in a wild rally. Their words, not mine. And Citi's $150 April target is still on the table. The House changed the rules mid-game, not because they're strong, because they're bleeding. And when the casino bleeds, you don't cash out. You press harder. The margin you pay today is nothing compared to the margin calls they'll be getting in April. Like, subscribe, and send this to everyone who thinks the rally is over. Because when the CME raises margins again next week, when silver cracks $120, when the force majeure declaration comes, they're going to kick themselves for not listening. The exchange just blinked. The volatility is compounding. And April is 10 weeks away. This is the American guy, signing off. Stay sharp and stay liquid.